calculate and interpret the leverage ratio, the rate of return on a margin transaction, and the security price at which an investor would receive a margin call. First, it is important to understand a few terms regarding leverage. When investors use leverage, they borrow money to buy a security. The loan, or margin loan, comes with an interest called the call money rate. Using leverage when buying a security greatly enhances the potential return or loss. Trader's equity is that portion of an investment that was purchased by the trader and not borrowed. The initial margin requirement is the minimum percent of the purchase price that must be the trader's equity. The leverage ratio is calculated by taking the total position size divided by the investor's equity. The leverage ratio shows how much more risky a leveraged position is relative to an unleveraged position. Walking through an example, if a trader buys $10,000 worth of stock, ABC, by borrowing $6,000 and putting up $4,000 of his own equity, the leverage ratio is $10,000 divided by $4,000, which equals 2.5. If stock ABC goes up 10%, then our trader's position would return 25% of the leverage position, significantly enhancing his return. When calculating the return on a leverage position, analysts need to take into account several factors, including the initial and ending equity amounts, the price change of the security, dividends or interest paid by the security, interest paid on the margin loan, and commissions paid to buy and sell the security. Once these items have been established, it is possible to calculate the return on a leverage position. Let's look at an example. While calculating the return on a leveraged position requires multiple steps, the formula is not much different than calculating the return of any security. Instead of taking beginning and ending values, however, we substitute beginning and ending equity. The realized gain or loss from a leveraged position will always be greater than any gain or loss of an unleveraged position. Moving on to the example. A trader buys 1,000 shares of stock ABC at $30 and sells it 1 year later at $26. The trader has a leverage ratio of 2.5. The broker charged 4% on the loan, and ABC paid a dividend of 15 cents per share. The commission was $10 per trade. The first step to calculating the return of a leveraged position is to calculate the initial equity. In order to do that, the analyst needs the total position size, in this case $30,000, and the leverage ratio. Taking 1 divided by the leverage ratio gives the analyst the equity percentage used to make the purchase. In this case, it is 40%, or $12,000. We therefore know the loan amount was $18,000. The total initial investment also must include the commissions, in this case $10. Next, the analyst needs to calculate the amount in dividends received and the interest on the loan paid. Since each share pays 15 cents, the total dividend amount received is $150. The interest on the loan, or call money rate, was 4%, so the total interest is equal to $720. Next, we need to calculate the remaining equity amount by taking into account the share price movement, dividends, commissions, and interest paid. We know that the shares were sold at $26, netting the trader $26,000, or a loss of $4,000. Deducting the commissions of $20, the margin interest of $720, adding in dividends, the remaining amount equals $25,420. Lastly, the trader must pay back the loan of $18,000. The remaining equity is $7,420. Finally, we can now calculate the return by plugging in the numbers. In this case, our trader lost 38.2% on this trade. Compare this loss to the loss had the trader been unleveraged, which equals minus 12.9%, and it becomes apparent how leverage can magnify potential returns. The maintenance margin is the minimum required amount of equity a trader must have in a position. Brokers typically institute maintenance margin requirements when a trader uses leverage in order to protect themselves in a situation where a trader cannot repay the loan. If a trader's equity drops below a certain threshold, then the trader will receive a margin call and be forced to supply more funds to increase their equity. If they do not, the broker will typically sell the position. Generally, maintenance margin requirements are usually 25% of the current value of the position, but can be higher or lower depending on the volatility of the security. In order to calculate when a margin call would occur, analysts must know the minimum maintenance requirement, initial equity per share, and the share price when the purchase was made. Suppose a broker has instituted a minimum maintenance of 25%, and a trader buys stock ABC on margin. Stock ABC trades at $24 per share, and the trader puts up $12 in equity per share and borrows the rest. In this case, the trader has margined 50% of the purchase. At what price would the trader receive a margin call? The formula to determine when a margin call occurs is a ratio. When the ratio falls below the minimum maintenance requirement, then a margin call would take place. The formula is initial equity per share plus current stock price minus price of stock ABC when trader bought shares, all divided by the current stock price. In this case, when the stock price is equal to $16 per share, the ratio is equal to 0.25. If stock ABC falls below $16, the trader would receive a margin call and be forced to put up more equity.